Good morning, good afternoon, good evening, dear community. We will start the learning session in 5 minutes. Just will allow all the participants to sign in. Thank you for your patience and collaboration. Okay, I hope this is a good time to start. We would like to be patient, but also in time with all the materials. So we hope all those who signed up for the learning session and who didn't join yet will join as we start. So good day, good afternoon, dear community. We are very happy to welcome you to our second We Learn learning session. Thank you, dear We Empower G7 and Women Empowerment Principles friends and collaborators for joining today. As you know, we launched our We Learn learning series last Friday with a session on how to boost your confidence, how you can be what you want to be. We received a lot of positive feedback, and you actually mentioned that you are very excited about the mix of soft skills and technical skills that are upcoming in the next learning sessions. So today we wanted to take a step further and to mix and match right from the beginning, and we will have the session on financial fundamentals. So you're exactly those type of technical skills that it's good to be in the mix. And what could be more relevant but finance in the time of COVID, but also in general for women entrepreneurs, for businesses, for startups, for everyone, even for our personal needs, right? So, and we have a great collaborator today. We have today with us Business Development Bank of Canada that will help us to understand those principles. So here's agenda for today. And I am very, very, very happy to say that today we will find out about these basic financial knowledge and skills you need, and we need all together to manage our businesses, finance, and make sound decisions to guide the company's growth. And of course, we will find out about cash flow management, about financial reports, how to analyze and improve company profits, and how to effectively speak to our bankers. And today we have with us our trainer, Laura Didyk, who is the Vice President and National Lead Women Entrepreneurs Business Development Bank of Canada. More about the bank and about the work she does and about the passion for women empowerment and women entrepreneurs, I will leave to Laura to share with our community. Thank you today for joining us. Laura, over to you.
Thank you, and good morning or good afternoon, depending on what part of the country you're from. So I think I'm going to get control here, and I'm going to show you my presentation. So my name is Laura Didyk. I'm the Vice President and National Lead for Women Entrepreneurs at BDC, and BDC is the only bank. Sorry, I'm just trying to get rid of something here. Is the only bank that's dedicated to entrepreneurs. And what we do is we provide financing and business advice for small and medium-sized businesses across Canada to help them start up and scale up. So what we're going to talk about today is your numbers and your story. So, you know, most people start out business because they're technically very good at something and they want the freedom of working for themselves and building a business, what that'll bring them. But, you know, they often get bogged down in the everyday busyness rather than educating themselves and becoming financially literate. And this is an area that's usually an area of we'll call it weakness for most business owners. You know, and imagine if you actually understand your financial reports and what they actually mean, and that your financial reports and the other key indicators that they can tell you are actually a valid tool for you to refer to. And if you understand them, then you are able to focus on strategies to help you grow. They are a tool. They're not just something you submit to the government for your taxes or for your stakeholders, but you can use them yourself. And your own level of financial literacy as a business owner can make a big difference to the success of your business. As a small business owner, you know, you don't have to run all the financial side of things. You don't have to become an accountant yourself, but gaining a degree of financial acumen means that you'll be able to manage some of your business's finances and go in with your eyes open. You'll be less reliant on others simply to tell you what to do in your business. And instead, you can enlist your financial professionals to talk through the options available to you with an understanding and with your eyes open, which is really important. And not only that, but it's really important is then when you do access loans or credit lines, and those are a key factor in helping you grow your business, it'll help the conversations when you have it with them. When the time comes to talk to those private equity firms or bankers or investors, you know, all of whom it's very possible as you grow your business, you'll need them to come into your business and to be a financial partner. The ability to be able to talk the talk is going to be really important, financially speaking, and it'll undoubtedly become invaluable to you. So we'll get started here. So there are one of the common problems that happen is that many people experience that the same statements have multiple names. And on the screen here, you can see that what the profit and loss statement is often can be referred to in a P&L statement or an income statement. Your cash flow statement can be also called the sources and uses statement, or the statement of financial position is another common term. Or in the balance sheet can be called the statement of financial position. So that's sort of to start. But I also want to spend a couple of minutes talking about the quality financial statements. And this causes a lot of confusion often amongst people. And there are generally 3 levels of quality, what they call quality of financial statements that your accountant can prepare. The first one is called a notice to reader, or a compilation of the information. And what that is the accountant or your bookkeeper just gets all the information from you as far as the numbers, and they put it into assets and liabilities, and into revenue and into expenses. They make sure that the assets balance in comparison to the liabilities and the equity. And they don't. What it doesn't do is they don't undergo any tests. And the accountant that is preparing them offers no opinions, no assurance. So that's why it's called a notice to reader. They're basically putting the reader on notice that they haven't done any validity tests. They've just compiled everything and basically put it on paper. So that's kind of what we'll call the lowest level, and hence the least expensive. The next one is an accountant reviewed financial statement, also sometimes called a review engagement. And what this is this means that the accountant has done some tests focusing on whether the statement is plausible. So making it more accurate in the reader's mind. So the accountant is preparing these statements. They don't give an opinion on the quality or the accuracy, but they've looked at the numbers and say, does that number make sense? And they give a level of assurance that that the numbers may be correct. And then the highest level, which is the most expensive, it takes the most time, is an audited financial statement. In an audited financial statement, what happens is it undergoes a reasonable number of tests to make sure that the assets and the debts reported are actually accurate. So sometimes that means an actual inventory count. It means that they'll contact, the banks and get a statement on what's outstanding. So they actually make sure. They don't do that with every line of the financial statement, but some of the lines that are very key. So the accountant is preparing them. So what they do is they give an opinion on the quality of the statements, and what they do is they let the reader know that the statement fairly represents the financial status of the company. So accountants provide outside users, in other words, your investors in your banks, usually bankers, that's usually who your outside users are of them, but it can be your suppliers or it can be other people, with assurance that someone independent has looked at your business's activity and is satisfied with it, that it's accurately and completely reflected in your financial statement. So it's giving a report on what your business's operations are and where it stands. So the more assurance that is required by the users of your business's financial statements, the more work that's required from the accountant. So depending on the kinds of investment you have or the kind of debt you have, then that's usually why people get different quality of financial statements, because obviously they get more expensive as the quality goes up, and you need to talk to your investors, your banker, about that, about what is required, because that's usually the only reason why you get different ones. So we're going to start with the income statement and understanding the profit and loss statement. So an income statement shows the profitability of your business over a specific period of time. So it is one of the fundamental documents that make up a company's financial reporting. So the income statement summarizes the revenues and the expenses resulting from the operations of the company, and it also shows the company's net profit or net loss. And it's basically your revenue minus your expenses. So your profit and loss statements are prepared according to accounting rules. And accounting rules require that revenue be recognized when a sale actually takes place. And this can be a little confusing for some people. So because in some instances, it means when the cash is actually received. But the accounting rules also require that expenses be recognized when they're incurred, which may be before cash is actually paid. So sometimes you'll make a sale, but you haven't actually received the cash because it's on credit or there's a receivable. And often, very often, you have to recognize your expenses, but you haven't actually paid them because your suppliers, it may be net 30, or it may go over an accounting cycle. And that's really important because that gets confusing for some people because they haven't actually paid the cash out, or they haven't actually paid the expense, so they're for their inventory or something to their supplier, but they have to recognize that expense when that sale is made. So you have to recognize it at the same time. So when these accounting rules are being used, a business is said to be using accrual accounting. So you'll hear that word a lot. So in other words, the revenue and expenses are being recognized in the same period rather than when the cash is actually received. And that's why the third statement, the statement of changes, is very important, because that kind of talks about what your cash is doing. We'll talk about that later. So when a business uses accrual accounting, accounting events and cash events are recognized at different times, and hence the profit will be different than the cash in and the cash out. So that explains that. And basically what it is just revenue minus your expenses. And this is an example of it. This is a very basic example, but this is an example of it. And what I want to emphasize here is that different than your balance sheet, your income statement is for a period. It's not as at a period. So it's for the year, in this case, the company's revenues were 100,000. Their cost of goods sold was 36,000, and so on. Like, say they're selling widgets and they had to manufacture those widgets. It cost them $36,000 to manufacture those widgets, and so from those widgets, the sale of those widgets, they made 64,000. But then they still have to subtract all of their operating expenses, all their fixed expenses. There could be rent, there could be, there's selling expenses, there's marketing, there's salaries, there's everything, lights, things like that. So you can see then once that's all paid, they made 20,000 in operating profit. And then they have to pay the interest on if they have debt or shareholder loans or something, they have to pay interest and income taxes. So you can see there, that's just a very basic example. And in some cases, you may not have cost of goods sold if it's a service business, for instance, because usually cost of goods sold is just in a business where you have an actual product, where you have something that you can touch. This is the balance sheet. So the balance sheet can be thought of a list of what the business owns and what the business owes. And this is as at a certain date. So often businesses own assets such as cash, accounts receivable, that's the money that's owed to them. They own their inventory, as well as fixed assets such as their building, maybe the land that it's on, equipment, computers, things like that. The liabilities on the other side are a category of what the business owes. So liabilities generally are, they consist of money owed to vendors, as well as to lenders. So if they have banks, whether it be their line of credit or through a term loan. And then there's owner's equity. And owner's equity is what the owners have invested. So it's usually your share capital and your retained earnings. And your retained earnings is what profit that the business has made that it's not paid out through dividends or other forms. So it's what the business has generated from your income statement that you've reinvested into your business. And when the balance sheet is prepared, assets must equal the liabilities plus the owner's equity. And that goes without saying, because you have to buy your assets somehow and you own them with something. So either you own them through debt or through your owner's equity or things like that. So the statement simply means that when a business acquires an asset, it will have a source of money to obtain that asset. So the money is either contributed from the owner, it's contributed from a bank, or you paid for it at the profits of your own business that you've reinvested. So that's why they have to equal at all times. And this is an example. So where this is different than an income statement is a balance sheet is as at. You can see there it says as at December 31st, 2000 XX. And so this is as at a certain date. So as at December 31st, this business had $25,000 in cash. It had $20,000 in inventory. So obviously this changes every day because your cash and your receivables and your payables change every day depending on what you're selling and that. And so this is as at that date, this is what it owned. And you can see that your total assets of 100,000 had to equal your total liabilities plus your owner's equity of 100,000 on the right side. And sometimes this isn't shown as, a left side and a right side. It's shown all in in one vertical manner, but the liabilities and then the owner's equity come after. This is just so you can see it easily. So that's that. So we're going to move on, and I know I'm moving really quickly, so we'll have some time at the end for questions, and whatever questions we can't answer, then I can answer through an email back. Because I know we're moving really quickly, but we're trying to get through this quite quickly. But the third one I want to talk about is understanding the cash flow statement. So the cash flow statement is a comprehensive measure of the cash flowed, of what the cash flow was in the business. So it pulls data from the income statement and the balance sheet to show all the sources and all the uses of cash and provides the net figure for the year. So a business can attain cash through multiple sources, and this can include, obviously it's the operations of the business, which is the most important, but it can also get cash from lenders, from investors. If you have another investor come in and you sell some of the company, it can be from the sale of assets. So if you sell a computer, if you sell a piece of equipment or something, or your building even, but only operating cash flow is sustainable. So that's, if you're talking to a bank, for instance, and they're looking at repayment, all the other items are usually like one-time items, or they're not ongoing items. It's the cash flow from the business, so the operating cash flow that any lender will find most important, and an investor for that matter. So a profitable business will generate cash flow from its operations, obviously, and if the operations of the business is not profitable, then to sustain the business, the cash has to come from somewhere else. And so, it can come from a bank, or it can come from an investor. So financing and asset activity cash flow comes from lenders or investors. So, and they're not as frequent. The idea is that they're, I don't want to call them one-time events, but they're more infrequent. So here's an example of a cash flow statement. So a cash flow statement it's like a profit and loss statement in that it reflects activity over a period. So it's over a period. So you can see in this example that the business started the year with $17,000 in cash. So cash in the bank, it had $17,000. You can see that it received $135,000 on the left side at the bottom there. It received $135,000 in cash through the years. So you can see in how it got that cash. So, it sold cash sales of $5,000 and so forth and so forth. Customer paid $75,000, had to pay its loan of $32,000, or it received $32,000 in a loan. And then you can see on the right side how it paid out its cash. So you can also see that the business paid out cash on the other side. So it purchased inventory, it had to pay interest, it had to pay, the government their income taxes. And you can see they had to pay some loan payments, they bought some assets. So you can see the total cash paid was $127,000. So at the end of the period, they had $25,000 in cash, and that in turn goes to your balance sheet. So this is really important for lenders especially, but also investors, because they can see at the end of the day, how much cash the business is generating. What's really important for them is the total operating. So where that cash is coming from, and because the idea is whatever cash the company is generating is what can repay the debt, and that's what lenders are really interested in, is where the repayment's coming from. So the other things that are really important that you can work with your accountant that comes from your financial statements are ratios. And ratios are super important because you can see, not only will you be able to, there's ways to be able to compare your ratios in your industry to some of your competitors in the same industry. And you can use a number of ratios, like RMA is a source where you can look at the ratios and you can compare yours to others, to the industry, to see where you're sitting and how you're doing. But also they're used by lenders because they show a lot of they give you a lot of information on how your business is performing. And the other thing you want to do is look at the trend. So when you look at year over year, how are your ratios trending? Are they getting worse? Are they getting better? And it really depends on your industry what a good ratio is on certain items. For instance, in some businesses, it's okay to have inventory sitting idle because it may not go bad. It can sit there for a long time. And so your inventory turnover, and maybe to get the inventory takes a long time. Maybe it has to come from overseas. So your inventory turnover may be quite low, and that's okay. And it may be in comparison to the industry, it may also be low, and so it's okay. But for instance, if you're in an industry where you have perishable inventory, like say a restaurant, you want your inventory turnover to be quite high, and your turnover is turning over quickly because you can't have it sitting there for very long. So it's really dependent on the industry. And so one of the ratios that people look at is your profitability ratio. And there's two kinds of profitability ratios. There's margin ratios and return ratios, and we're going to talk about margin ratios today. Margin ratios examine how effectively your company is transforming their revenues into profits. And so we're talking about return because they are used the most, especially if you're looking to borrow, but return ratios are important too. So gross margin measures how much sales a company has left over after it's covered all its cost of goods sold. So the higher the profit margin, the better, basically. It means that you have more cash left over to cover the operating expenses, such as taxes, to cover your operating expenses, your taxes, your depreciation, all your other business costs. So, it doesn't matter the industry that you're in. I would say all these, the higher the ratio is, the better. Operating profit ratio, on the other hand, basically is you'll hear the term EBIT a lot. So it's your earnings before interest and taxes. So it takes your gross profit and it deducts your operating expenses. And operating expenses are things like commissions, administrative expenses, general costs, and it puts it over your sales. So it tells you what you're making on each sale dollar, what you're making, and that's really important. And then finally, your net margin is something that's used a lot, and your net margin is bottom line, kind of what you're making. And as a small business owner, the profitability measurement that matters the most to you is your net profit margin, because it reveals at the end of the day how much money your company earns bottom line on each dollar of sale it's making. So, net profit margin shows the percentage of your profits that your company keeps from each sale after all of its expenses, your operating expenses, your non-operating expenses are paid, what you're making. And that's really important. Obviously, the higher the number, the better. So then there's liquidity ratios, and liquidity ratios is something that is really important also. So these measurements, what it does, liquidity ratios, it measures the amount of liquidity, so cash and assets that are easily converted into cash, that you have to cover all your debts. And it provides you a broad overview of the company's financial health. So, at the end of the day, businesses fail when they cannot pay their bills. And liquidity ratios are one of the measures that measures a business's ability to pay its upcoming bills, because assets are good things to have, but if you can't sell them quickly and pay all your operating expenses or pay all your bills, then they're not much use. So your liquidity is really important. So your current ratio measures the company's ability to generate cash to meet your short-term financial commitments. So it's also called a working capital ratio. You'll often hear that. Current ratio and working capital ratio are the same thing. And what it is numerically, it's your current assets, which are things like cash, inventory, receivables. So anything that you can transform into cash within 12 months, they say is current. And it's divided by your current liabilities, which are things that are due within 12 months. So it's like your line of credit is a short-term liability. Your accounts payable usually have to be paid within the year, so it's a short-term liability. And any current portion of long-term debt. So if you have a building mortgage, for instance, over 20 or 25 years, or even equipment line that's an equipment loan that's due over 5 years, there's monthly payments. So it's the next 12 months of payments that you have to pay your bank, the current portion of term debt that's included in your current liabilities. And it just divides the two. Generally, a current ratio over 1 is means that you have is good, because what that means, and I'm saying generally because it's not all the time, but I mean, I would say 99% of the cases you'd like it to be over 1, and this is where it's really important to compare it to other in your industry, because it means that you have more current assets than you do current liabilities. So you own more liquidity than you owe, and that's really important. The quick ratio isn't used, I find, isn't used as much by owners, but it's used by banks. And the quick ratio measures your ability to access cash quickly to support your immediate demands. So you'll also hear the term acid test, and that's a quick ratio. And banks use this a lot because it divides your current assets, not including your inventory. So it includes your inventory, and it divides that by your current liabilities, excluding your current portion of term debt. And again, a ratio, what they're looking for often is a ratio greater than 1. But it can vary depending on your industry, but that's generally what they're looking for. And if you have, in either of these, if you have a low ratio, it means that your company is probably gonna, or is having, or is going to have difficult meeting your current obligations, and will have to, look somewhere else for that cash, whether it be through additional investments or through additional debt. And that's why banks are really looking at that, because they want to make sure that you can meet your current liabilities, or meet your current your obligations, immediate obligations. So then the other ratio is leverage. So leverage, I use, it's like a teeter-totter, and leverage is looking at, on one side, sort of your debt compared to your equity. So how much you're leveraging your equity of your business. So these ratios provide an indication on the long-term solvency of a company, and to what extent you're using long-term debt to support your business. So debt to equity is super common. It's used by bankers. You'll hear it often, and it's used to see how your assets are being financed, basically, when it comes to creditors or your own investment. So are you using your own investment, or using somewhere else, like a banker? It indicates the amount of liabilities the business has for every dollar of shareholders' equity. So equity is defined as the assets available for collateral after the priority lenders have been repaid. So, and if I use the analogy of your house, if you own your house, and usually you've borrowed, say, 75% of the total market value of your house, so you have 25% in equity in that house. And you can use the same for any of your business assets. If you buy equipment, not very often a bank often will lend up to 100%. But as you pay it down, if you borrow 50% on equipment, then technically you own 50% of the equipment, and the bank owns 50% of the equipment in a worst case scenario. And as you pay it down, then you have more and more equity in that equipment. Now, obviously, it depreciates over time, but that gives an idea of sort of how much equity is available in your business to leverage, so to give to the bank. So in general, a bank considers a lower ratio to be a good indicator of your ability to repay your debts, or take on additional debts, I think, is what's more important. And you never want to be leveraged, or you don't very often want to be leveraged 1-to-1, and you for sure never want to be, sometimes a bank will look at 3-to-1. And so for every dollar you've invested in equity, they'll lend up to 3, and it really depends on the industry, but that's what they're really looking at. And that's why they only lend, say, 75% on a building or 50% on equipment, because that's the leverage they're looking at. Another important ratio is your interest coverage ratio. And your interest coverage ratio is a measure of the company's ability to meet its interest payments. And this is really important, because your interest payments are what's due going on and on. So interest coverage ratio is equal to the earnings before your interest and your taxes. So it's your operating, after all your expenses, except for your interest and your taxes, over the period, and it's divided by your interest expense. So it sees how much money is left to pay for your interest. And banks use that a lot. And same with your fixed payment coverage. And what this does, it measures the firm's ability to meet its fixed charge obligations. So it's your bottom line, EBITDA, and I have EBITDA listed there because EBITDA stands for earnings before interest, tax, and depreciation and amortization. And what your fixed payment coverage ratio does is it takes that EBITDA and it divides by your total debt service. So your annual principal payments, so whatever you owe the bank on principal for the year, plus your interest payments. So basically what it's doing is it's calculating of the earnings that your business is generating. It looks at the leverage, or it looks at the ratio of how much is left to repay its interest. And because don't forget, banks are not only interested in your regular payments, but they're also interested in your interest payments. And so making sure that you can pay your interest payments. So the next one we'll go through is understanding your working capital. So working capital is a measure of your liquid assets available to be used in the operation of the business. So this is really important because working capital is your current assets minus your current liabilities. So current assets I had talked about before, it's your cash, your inventory, your receivables, and your current liabilities are your accounts payable. And what it does is it takes your current assets and it subtracts your current liabilities. And working capital is a measure of your liquid assets available for the operation of the business. And generally, and I'm saying generally, you want working capital to be positive. Again, just like your current ratio and everything else, you want your current assets to be more than your current liabilities. In some cases, in some industries, it's okay to have a negative working capital position because your inventory is turning over so quickly that it may be okay. But generally, you want more assets than more liabilities on a current basis. And if you have negative, depending on the industry you're in, then it just means that you, like I mentioned before, it doesn't mean you have enough, it means that you don't have enough cash to pay what's coming due within the next year. And that's a problem. And if you don't have enough working capital to pay what's due within a year, then you need to look at other sources. So your business is not generating enough cash, so it needs to look at you need to look at other sources. And this is where some ways of getting additional working capital is to borrow. So that's usually what your line of credit is for, your operating line of credit, or you need to look at new investors, or you need to look at a term lender, or you'll need to invest more money. And this is really important. So because often business owners will just look at the cash they have in the bank, but they're not looking at what their business is generating in cash and where it's generating cash. And this is really important. And working capital is really needed, not only to start up a business. Some people say it takes more money it takes more money to grow a business than it takes to start a business. Because if you're growing a business, it takes a lot of working capital. Because what happens is you need to purchase, your sales are growing so quickly, and you need to purchase inventory so quickly, and you need cash to purchase that inventory so quickly, and your cash isn't coming in as quickly. Because usually, what happens is in most cases, you're buying inventory before you're selling it. And so you need that cash to purchase your inventory or to pay for it before you can actually sell it. And especially now with credit cards and everything, that you have a lag in collecting your cash in a lot of cases. And so that's really, really important because it takes a lot of cash to grow a business. And this is where, financing comes in, and the importance of getting enough financing or enough investment to make sure your working capital is in good position to grow your business. And so that's that. So I finished with the accounting, the numbers part. And what I wanted to do now is to talk about financing. And I talked about it a little bit throughout the presentation, but I really wanted to, we have 10 minutes left. So for the next 10 minutes, I just wanted to talk about financing, what banks are looking at, because this is really important. What we found when we did our surveys, especially through COVID, but in growth, in surviving, and in thriving, financing and securing financing is a top priority for all entrepreneurs, but especially for women entrepreneurs. And sometimes they don't understand what banks are looking for or how to talk to banks. So I wanted to, thought I'd go through kind of what our 5 tips are to help your banker finance your business. And because it's a very important part of your business. And specifically, I'm going to give you some tips on what you should think about when and if you want to get a business loan and when you're talking to a bank. And a loan, as I mentioned, can fuel your business to reach the next level of success. So you have to make sure that you have the right kind of loan for your needs. And there is too much debt, and there's also not very good terms and conditions. You need to make sure that you can ask the right questions and that you know what they're looking for. So I'm going to share some of the common mistakes that we see entrepreneurs making when they come to us for a loan. And at the outset, I should also mention that our research shows that women business owners are particularly prone to these errors, because I find that they sometimes, the financial literacy just isn't an interest of theirs, and they don't really understand the numbers. And that's why it's important to understand kind of what a bank is going to ask you for and to educate yourself on what the good questions are. So the first thing is understand what your banker wants to know. So, for this, some of the things, first of all, I want to start with, a banker needs to sell money. I mean, and basically it's rented money, right? And the rent is the interest, and then the principal is what you have to repay. And they don't have a business if they don't lend. And so they do want to lend. That's how they make their money, is on interest. They don't make it on deposits, they make it on interest. They pay out on deposits and they make the money on interest, and obviously the fees and everything else that go with it. But at the end of the day, they need to sell their product too, which is the money. And so, they do want to lend, but they're also managing the risk at the same time, because, they want to make sure that all their risks are managed. So one thing they're going to be asking themselves is, are you and your business an acceptable risk? And they're business people. So put yourselves in their shoes. So they're always on the lookout for new clients, and they want to minimize their risk. So think about the risk standpoint, because that's what they're managing. At the end of the day, they are managing risk, and they are pricing for that risk. So they're going to look at your personal and professional profile, and that's the start, because you own the business. And I say you, it's like you and your shareholders, whoever's operating and managing the business. So they're going to look at you and your team. They're going to say, okay, do these people have what it takes to succeed? Do they have the experience? Do they have the expertise needed to bring this project, so what you're doing, to fruition and to make it successful? They're also going to look at, what is your personal capacity to invest more funds into the business if worst case scenario happens and the business does not take off as quickly as you expect, or does not do as well as you expect, or there's some unforeseen cost or something like a global pandemic hits. What is your personal capacity to invest more money into the business? And are you personally completely leveraged up and tapped out, and you're living from check to check, and so you can't invest anything else? And do you have the ability to get more money into the business? Because if you don't, then that puts the onus on them. Then in a worst case scenario, they'll have to lend more, and they may not want to. They're also going to be looking at the viability of your project. So what is the expected benefit of the project for the business? So if you're buying a building, what is that going to do for the business? If you're buying equipment, how is that going to turn into money for the business? And if you don't complete the project, what is the impact on the business? And do you have a plan B? And what impact will the project have on the continuity of your business's operations? So do you have to, for instance, if you're buying a building and you're moving your operations, do you have to shut down for some time? And how will that, if you're operating at full capacity and you're moving into a bigger building, how long will that take you to move into a bigger building? And do you have enough inventory to then sustain your sales and things like that? So it's gonna see how, whatever you're borrowing the money for, we'll call that your project, the viability of it, and what's that gonna turn into. they're also going to turn into, and they're also going to ask your financial capacity. So do you have the capacity to reimburse your loan? And this is where those numbers come in. So, you know, the financial statements. This is where they're looking at the financial statements. And, you know, how much money is the business generating? How much cash is the business generating? How much debt does it have to repay? How much, you know, rent does it have to pay? Things like that. It's looking at the cash, and if it's really tight, is the project going to increase the cash flow or the operations or the profitability of your business enough to repay this debt? And they're also going to ask it under your financial capacity, what is your participation as a shareholder in the risk of the project? So a bank never wants to take on the, you know, never wants to take on the whole risk. They want to, what they say, risk share a project. So if you're buying a building, if you're buying equipment, you know, how much are you going to invest? If it's $50,000, you know, say, you know, maybe they'll lend 25,000 and they would like you or your business to put in 25,000. So how much are you personally investing into the business yourself? And that's going to be important. And then finally, the banker is going to want to know your market. So think about that. And so come prepared knowing your market, what the reality is, are what the economic context is, and this is really important right now, especially right now, what the competitive landscaping looks like, things like that, like really, and you know your market better than anyone. And so that's what they're going to be asking you. And the second tip is know what you want. So know the amount of money you're asking for and make sure it's enough. Women tend to not ask for enough money, so make sure it's enough money. You know, come in prepared to know what interest rate you want to pay, how much flexibility you want in your repayment, as well as the collateral you're willing to pledge. And think about that before. Obviously, they're going to have demands, but think about that before. What is a reasonable interest rate? What is reasonable fees? You know, what is the collateral that you have? What's already pledged and what you have left and what you're prepared to give? And what repayment? Do you have seasonality in your business? If you're building a building, do you want your payments deferred for a little bit while you're building it? Because you need some time before you're up and running again, things like that. And that's really important. And that's where that becomes more important sometimes than just the interest rate, is some of the terms and conditions. So think about that a little bit. Because you really need to understand the details of the loan. And this, I want to spend a little bit of time here, because people are often really, the first question I often get is, well, what's the interest rate? But the interest rate is only one element of the question. What I like to talk about is the total cost of financing. So, you know, you need to look at not only what the interest rate is, but what the fees are. Is there an upfront processing fee? Is there an annual fee? Is there a monthly fee? Things like that, because that, at the end of the day, I mean, banks will sometimes decrease their interest rate, but then they'll just increase their fees. At the end of the day, it's all revenue to them. They don't care how they get it. You know, and often how much flexibility do you need? And maybe you pay a little more. And I use the analogy when I go to a grocery store, if I want them to bag my groceries and take it out to my car, you know, it may be a store that each product cost is a little higher to pay for that service. Whereas if I go into a store where I have to bag my own groceries, I have to bring my own bags, I have to do everything, then, you know, it may be a less expensive store, but the service isn't there. So you need to, the same kind of works for a bank. The more flexibility you want in your loan, being, you know, maybe the length of the loan, whether it be 20 or 25 years or 5 years, being it whether it be you get seasonal payments, or whether you get a principal moratorium for a number of months or even up to a year, then that may become more important to you than the interest rate, because that's really important to you. And don't forget that your interest payments are tax deductible. So when you're looking at an interest rate and your fees, it all goes on your income statement. It's all tax deductible. And right now interest rates are so low that, you know, it's really beneficial. So at the end of the day, if you can borrow money at a rate that is low enough that if you invest that money into your business and you can make more money than what you're paying the bank, so you're putting more money in your pocket, then it's beneficial to grow your business. If you need that money to get your business to a stage that it couldn't have been at without that money, then it's really beneficial to borrow money. And the length of the loan is also really important, and the collateral. So, and what are the prepayment penalties? So if the length of the loan and what are the prepayments? So are you allowed to put down an amount free of charge every year? Or if you want to repay the whole loan early, then, these are all things that become sometimes, depending on your situation, more important than the interest rate. And just remember that the less collateral you're able to pledge and the more flexibility you want, the higher the interest rate's going to go. And if you have tons of collateral and you don't need any flexibility and you're willing to go with the standard length of loan, then the interest rate will be lower. The third one is to prepare for your first meeting. And this is where, again, I'll take all this to account. Just take a few minutes to think about what you're doing, what the benefits are, how much you want, and things like that. And that's really important. And come in prepared. Think about your market. Think about everything. The fourth thing is, when you do get financing, keep building the relationship with your banker. Don't just get your money, and keep them up to date, and keep them, if something, the unforeseen happens and things don't go as well as what you think they're going to go, then that's okay. But make sure that they know what's going on, and be really honest with them, and come with a plan. Come with a plan on what your plan B is. Say, look, sales haven't gone as long as I wanted, or the building costs more than what I expected, or it's taking me a little longer to get the equipment up and running. And so sales aren't what I expected, but this is my, I've found another shareholder, or I'm investing some more money, or I need a postponement, but this is how I'm going to do it. And don't let the bank, don't let your banker be last to know. I would keep the relationship really strong. And that can be a little frustrating sometimes, because often in banks, the account manager turns over, you don't even know who they are, but really try to make an effort, even if it's just through email or through technology, to try to keep the relationship as strong as you can. And then the last thing is to avoid common mistakes. So these are some of the common mistakes that sometimes happen. So often people borrow too late. The best time to borrow money is when you don't really need it, quite frankly. And you're tempted to find, things are going so well that you're tempted to finance expansion projects on your own and using your day-to-day money. But if interest rates are low, and if you're doing well, and again, if using the money from your operations can leave your company a little tight, then it's sometimes better to borrow the money, especially if you have the security and everything. And think about that, because often people come when it's too late, and they need the money and they needed it yesterday. The second mistake that people often make is borrowing too little. And I mentioned this, it makes good sense. Now, I use the analogy that it's like a rope. Imagine that you're out in the ocean and you're swimming, and you need a rope to get back in. You don't want a banker to throw you a rope that's too short, because that's not going to help you. So sometimes companies and this often happens with women entrepreneurs, they don't borrow enough. And they're still out there, they're still 500 feet out there, but the rope was only 250 feet. So it hasn't helped them. They have to swim to the rope, and they have to swim quick. But you also don't want a rope that's 750 feet. You don't want to borrow too much, because there's interest on that and it'll cost you money. And so you can borrow too much. So you don't want to borrow too little, you don't want to borrow too much. So this is where understanding your financial statements, working with your accountant and your banker to make sure that you do borrow enough, and you think about a little bit of a contingency, because more often than not, you'll need a little more. The third mistake, is paying your loan back too fast. And this often happens. Many business owners, they don't like the idea of debt, especially women business owners. I think we were brought up that way, that debt is a bad thing, and they really want to reduce their debt. But reducing your debt too quickly can become a cost to your business. So, again, don't leave yourself short of cash. Make sure you have a little bit of extra money. Make sure you have a good operating line of credit. And if you expect to earn more, investing your money in your business, considering slowing down your repayment terms if you can. Like if you can reinvest that money and do the business a benefit and make money from it, then it's probably worth it to keep the loan outstanding. So just Think about that. They often just want, they brag that they haven't got any debt, but sometimes they could have got the business to where it needs to be faster if they would have borrowed debt. So I'd like to end, this is my final slide, with a recommendation to visit our website. So bdc.ca, check out our ebook section where you can get a full picture of your business's financial health. We have lots of free guides on there. You can take a course. We have lots of free ebooks. We have a tab called, your company's finances. It'll help you steer you in the right direction. There's an ebook there to help you discover how to analyze your balance sheet, your income statement, and your statement of retained earnings and your cash flow. There's this presentation on what your banker and investors are looking for. How to calculate, you can also calculate your own ratios using our website, all for free. And there's a cash flow quiz that you can take that's brand new, that are designed for entrepreneurs to help you with the survival of your business, especially in these times. It's really important. So if you go to our website, bdc.ca, under Entrepreneurs Toolkit, so if you go under there, all the information there is free, and I find that it's really, really useful for a lot of people. So I would highly recommend, if you get anything out of this presentation, that's the one thing I'd recommend that you do. So that's the end of my presentation. That's my my coordinates if you'd like to get a hold of me. And also I encourage you all to follow me on LinkedIn. I try to post some very relevant information on LinkedIn for women entrepreneurs, not only from ourselves, but obviously from all of our partners and other people in the ecosystem. So I thank you very much. And I think now if we have a little bit of time, I don't think we'll have too much time, but if you can submit your questions, then we will answer them, I promise. We'll get back to everybody with your the answers to your questions.
Thank you so much, Laura. This was so insightful. We do have many questions, very particular actually, but maybe 3 of them that were repeated throughout. So, so a balance sheet is similar to a financial statement. Do banks care or if you are only a bootstrapper? And then some question around working capital. How to know that one has enough working capital, the distribution of money is correct in order to invest? Some question also were around the credits and the 5 C's of credits. So yeah, maybe we can take this as a more general and repeated one, and then we have some 2 questions to assess our learning today, and over to you for some thoughts about the questions that we shared.
Yeah, so I think they're longer answers. So I think what's best, just given that the time that we have, that maybe you can send me the questions and I can answer them, and then we can submit them back to the people that ask the questions. I mean, working capital, it really depends on your industry. So, and if you go onto our website, you can actually input some stuff and compare it to RMA. And I think that's really important, is for working capital, you need to, it needs to be really dependent on your industry, and you need to compare it to the industry norms to know if you have enough. And it depends on how much debt you have. So, that's how I can answer that one right now. And I think it just involves a little bit of a longer of an answer.
Sounds good. So how about we will take a poll, but it comes in form of a question, so we can understand if we were good learners today. The question is around the revenue. Dear all, please select the answer that you find or you think is the correct one. Revenue might be recognized before cash. I'm sorry, I'm not sure why I'm not seeing entire question, but I hope you do. And it's not very hard for you to choose. Maybe there is some glitch from my end, but if I'm correct, it should be revenue may be recognized before cash is received. Revenue might be recognized when cash is received, and revenue may be recognized after cash is received. So please do choose the correct answer from your end. Thank you so much for your, let's see how well we did. I think the majority of us responded correctly to the question. Laura, can you confirm?
Yeah. So that's the biggest misnomer, is that revenue may be recognized before the cash is received.
And then the second question that we have, when financing your business, what your banker will look for? It will look for your personal and professional profile, the viability of your project, your financial capacity, your market, all of the above, or maybe we're missing something, maybe a driving license, or I don't know. So while we are responding, I also would like to invite the manager of We Empower G7 program, head Women Empowerment Principles Secretariat, Anna Pals, for some closing remarks and observation around the learning session. Over to you, Anna.
Thank you so much, Diana. I'm actually very curious to see the answer to this question, if people got it right, and also have Laura's reflection on the answers. So yeah, I think
very
everyone,
smart group, all of the above, definitely.
Yeah. Thank you very much. So thank you so much, Laura. This has been a really insightful session for all of us, whether we are in employees or whether we are entrepreneurs. It's always very insightful to understand the accountings and also what banks are looking for. Diana will continue with a few more questions, not learning questions, but more like how more confidence you feel about the topic. But I see that there are other questions. Some of them are related to COVID and specific tactics during this time. So we will certainly take all of the questions and share with Laura. And I'm thinking that we can both send it to the individuals that have asked the question, but I think many of these questions would be relevant for all of us to have answers. So I'm thinking also we can put it on our website, to the events page where everyone came to register. And also to wrap up on this, I think that I'm very excited about all the people that have joined, and they had very, very great questions. That this is the beginning of our learning series. As Diana was saying, we started last Friday focusing on confidence, and we are mixing with technical skills like finance, which is something very, very important. We'll continue with leadership and entrepreneurship and other topics, along with assertiveness and communication and other areas. So you will see the next session is on the 7th of October. Thanks, Diana, for pulling that up. Having a seat at the table with Minda Hart. She's the CEO of the Memo and professor at NYU. And then we'll have another session on the 9th of October, focusing on women on boards. And we hope that you all will be able to join these sessions. We have different people coming in at different times to share their expertise, like Laura did today. I see that in the financial area, there's a lot more to be discovered, as we saw from the question on the 5 C's on credit, for example. But it is a concern, particularly in COVID times. So hopefully we'll continue this collaboration with you, Laura. And just to end with that, a big thank also to the European Union that have funded our program, the We Empower G7 program, that are running these sessions, and also to encourage all of those that are business owners that have attended today to join us in signing the Women's Empowerment Principles. The Women's Empowerment Principles is really a way to show solidarity for gender equality, to make that commitment and really connect from banks being committed to lend and be developing products and services that serve the needs of women entrepreneurs, but also for women entrepreneurs to think about who they buy from and who they engage with business partners, that they're also thinking about that from a gender perspective and also show solidarity to other women entrepreneurs. Finally, I'd like to thank you, Laura, for joining us today, for the entire audience, Diana for moderating, and also the other team members of the We Empower G7 team, and particularly Stephanie that made this connection and this session happen. So thank you very much. And we look forward to your participation in our upcoming online session. Thank you very much.
Thank you, Anna. Thank you, Laura. Thank you very much to our partner today, Business Development Bank of Canada. Thank you all. Please stay safe, and until next time, have a good day.
Thank you.